So, what if you could invest in your hometown the same way you invest in a company? Well, today we're diving into a brand new kind of financial tool that actually makes that possible. And you know what? It might just change the future of our cities.
Okay, so we've all seen this guy, right? The charging bull. It's the symbol of Wall Street, the place you go to buy a piece of the biggest companies in the world. But what if you wanted to buy something even bigger?
I mean, seriously, can you buy and sell an entire city on the stock exchange? It sounds like something straight out of a sci-fi movie, doesn't it? The idea of trading a whole city, its streets, its people, its entire economy, like it was just another share of Apple or Microsoft. I mean, could that really be a thing?
Well, believe it or not, the answer is yes. Apparently, so. In 2024, in a totally unprecedented move, the economy of an entire American city, we're talking Nashville, Tennessee, was packaged up into a single investment and listed right there on the New York Stock Exchange for anyone to buy.
Yep, it's called Nash. For around $25 a share, you can buy into a portfolio of 24 major companies that are all headquartered in and around Nashville. This is the first ever city-based exchange-traded fund, or ETF. And that, of course, brings up the big question, what on earth is an ETF?
Okay, so to really get why ETFs were such a game changer, you've got to understand what came before them. There were basically two older and kind of flawed ways for investors to do this kind of thing.
So for a long, long time, investors were stuck with this fundamental trade-off. You could either have flexibility or you could have scale. But getting both? Nope, not an option. So on one side, you had what are called open-end mutual funds. Now, these were great because they could grow and shrink as people put money in or took it out. But the problems? They had to keep a bunch of cash on hand to pay people out. And you could only trade them once a day at a fixed price. Then on the other side, you had closed-end funds. Now, these were cool because their shares traded all day long, just like a regular stock. Super flexible. But the catch? They had a fixed number of shares. They couldn't just create more if demand went up. So you see the problem, right? You got flexibility or you got scale. You couldn't have.
And this is the exact problem the ETF was created to solve. It's a really elegant solution when you think about it. It's an investment fund that holds this whole collection or basket of stocks, but, and here's the magic part, it trades on an exchange just like a single stock. So you get the scale of a mutual fund and the flexibility of a closed-end fund. It really is the best of both worlds. So once the financial world figured out this whole basket concept for ETFs, they kind of went wild with it. They realized they could fill these baskets with just about anything you can imagine.
For example, you can buy a basket that tracks the entire market, like the S&P 500. With one click, you own a tiny little piece of the 500 biggest companies in the US. It's like buying the whole haystack instead of looking for the needle.
But what if you don't want the whole market? No problem. You could buy a basket that only holds tech stocks, or just energy companies, or maybe only healthcare. You can get super specific and target your investments with some incredible precision.
And it doesn't even stop with stocks. You can buy an ETF that holds a physical commodity, like gold. Buying a share of one of those is basically like buying a tiny slice of a real gold bar, except you don't have to worry about where to store it.
And yeah, you guessed it. In today's world, there are even ETFs that hold a basket of cryptocurrencies, so you can get exposure to that whole world without the headache of managing a bunch of different digital wallets.
Okay, now this is where things get really interesting. ETFs also let you see how different parts of the economy play off each other. This chart here is called a correlation matrix. I know, it looks complicated, but the idea is actually pretty simple. Let's take a look. Find the row for utilities, that's XLU. Now, follow it across to the column for financials, XLF. See that number? It's negative 0.23. All that means is that when utility stocks are doing well, financial stocks tend to be doing not so well, and vice versa. They basically move in opposite directions. And that is the secret sauce of diversification. When you own a bunch of things that don't all move up and down together, you smooth out the bumps and lower your overall risk. So at this point, ETFs probably sound pretty perfect, right? Well, hold on a second. Like any investment out there, there are definitely some pros and cons you need to know about. The benefits are pretty clear, right? You get instant diversification, you can trade all day long, and the fees are generally way lower. But there's no such thing as a free lunch. The disadvantages? Well, you might have to pay broker commissions every time you buy or sell. There are also operating expenses, called the expense ratio. And there's a risk that the ETF doesn't perfectly track its index. Plus, if you bet big on one specific sector and that whole sector has a bad year, well, you're going to feel it.
And even inside the world of ETFs, there are two really different ways of thinking. First, you've got passive management. The goal here is super simple. Just track a market index, like the S&P 500. No more, no less. It's cheap, it's efficient, and it's what those robo-advisors you hear about typically use. Then you have active management. This is where a real person, a fund manager, is actively trying to beat the market by picking what they think are winning stocks. And for that potential genius, you're going to pay much higher fees.
So the big question is it worth paying those higher fees for an active manager? Well, a recent study came out with a pretty shocking answer. Over the long haul, only 1% of active fund managers actually did better than the S&P 500. Just 1%. Turns out, consistently outsmarting the entire market is, well, it's pretty much impossible. And that brings us all the way back to where we started. If you can stuff pretty much anything into an ETF basket, then why not a city? What does it even mean to invest in a city? Well, the idea behind the Nashville ETF, or NASH, is that every city's economy is its own little ecosystem, right? It's got its own unique resources, laws, and people. So the thinking goes, if you invest in a basket of its top companies, you're basically making a direct bet on the future success of that specific city. Now, as you can imagine, this idea kicked off a huge debate. The bull case, or the optimistic view, is that when local economies are strong and independent, it makes the whole country's economy more resilient. So investing locally just makes sense. But the bear case, the more pessimistic view, fired right back. Critics said it's actually a pretty bad idea. They argue that putting your investment money into the same local economy where you already live and work is the exact opposite of diversification. It's putting all your eggs in one basket. And all of this leaves us with one last, really fascinating question to chew on. If your city can be bought and sold on the stock market, does your mayor basically become its CEO? Do we start judging them not just on policy, but on their city's stock price? It's a wild thought, but it's a question we might all have to grapple with a lot sooner than we think.